The most important 48 hours for your portfolio, Fed decision plus big tech earnings. In the next 48 hours, two of the most powerful forces in the stock market are going to collide at exactly the same time. On Wednesday, the Federal Reserve announces its interest rate decision. The same week, 5 of the biggest companies on the planet report their quarterly earnings. Companies whose combined market value is larger than the entire GDP of Japan. The S&P 500 is sitting at an all-time high right now, 7,165, a number most analysts weren't forecasting until late 2026. The NASDAQ is also at a record. So the question isn't just what happens at the Fed meeting. The question is, what happens when a central bank with its hands tied by inflation meets an earnings season that everyone is treating as a referendum on whether AI is actually delivering results? That's what we're breaking down today. Stay with me, because this one matters. Let's set the stage. The Federal Open Market Committee, the group inside the Federal Reserve that actually sets interest rates, meets Tuesday and Wednesday this week. They've held rates steady at 3.5% to 3.75% for 2 consecutive meetings now, and right now the market is pricing in a 99.7% probability that they hold again on Wednesday. But here's why this meeting still matters. It's not the rate decision that moves markets. It's what Federal Reserve Chair Jerome Powell says in his press conference right after. The language the Fed uses, words like patient, elevated, or data-dependent, sends signals about when rate cuts might actually arrive, and the backdrop is complicated. March inflation came in at 3.3%, the highest reading since May 2024. That's not a small number. Gasoline rose almost 19% in a single month. Fuel oil jumped over 44%. Both of those are direct consequences of the US-Iran war and the disruption to energy markets. The Fed can't ignore that, even if the cause is temporary. At the exact same time, and this is what makes this week extraordinary, 5 of the Magnificent 7 companies are reporting earnings. That's Microsoft, Meta, Amazon, Apple, and more, all within a 48-hour window. Goldman Sachs research estimates that AI-driven investments will account for roughly 40% of all S&P 500 earnings growth in 2026. That is an enormous concentration of the market's growth story in one technology theme, and this week, that theme gets graded. Let's start with the Fed. Back in March, the Federal Reserve projected 1 rate cut in 2026. That already felt cautious. But then March inflation came out, and 3.3% is the kind of number that makes a central bank even more cautious. Think about what 3.3% means in plain terms. The Fed's inflation target is 2%. They're still more than a full percentage point above that. Gasoline prices surged nearly 19% in a single month. Fuel oil, the kind used to heat homes in colder states, jumped over 44%. Those are not minor fluctuations. Those are energy price shocks that feed into transportation costs, manufacturing costs, and ultimately into what consumers pay for everything. Now, the Fed knows that much of this inflation is tied to the Iran war and the disruption to oil markets. That's a specific cause, not a broad overheating economy. But their job isn't to wait and see if a geopolitical conflict resolves. Their job is to keep prices stable, and right now, prices are not stable enough to justify a rate cut. So what will Powell say on Wednesday? Listen for 2 things. First, does he describe inflation as elevated, which is relatively calm language, or does he use stronger language that suggests more concern? Second, does he still reference a potential cut later in 2026, or does he go silent on the timeline entirely? That silence would send a message of its own. Now let's talk about the other half of this week, and honestly the part that might matter even more for where markets go next. Last week, Intel, a company many investors had written off, reported first-quarter earnings that shocked the market. Revenue came in at $13.6 billion, up 7% year over year. Their data center division, the business selling AI infrastructure, grew 22%. Their stock surged 23% in a single day. That's one data point. But it signaled something bigger. If Intel is winning on AI infrastructure, what does that mean for NVIDIA, which already retook a $5 trillion market capitalization this week? What does it mean for Microsoft, Meta, Amazon, and Apple, all of whom report their own earnings starting Wednesday? Here's the number that puts all of this in context. Goldman Sachs estimates that AI-related investments will account for roughly 40% of all S&P 500 earnings growth in 2026. Think about that. Nearly half the earnings growth of the 500 largest companies in America is projected to come from one theme: artificial intelligence. That is an enormous bet. It's the kind of concentration that produces spectacular rallies when it works, and sharp corrections when it doesn't. This week is the quarter where AI gets graded on actual results, not promises, not "we're investing in AI," not "we expect AI to drive growth." Actual revenue, actual profit margins, actual evidence that the billions of dollars poured into data centers and AI models are translating into business results that justify the valuations. If the Magnificent Seven deliver, watch the S&P 500 push towards 7,300. If even 2 or 3 disappoint, especially Microsoft, which is already down significantly this year, the market's foundation gets tested in a hurry. So here's where it gets interesting, and where it gets relevant to your actual portfolio. You have two forces colliding this week. A Fed that almost certainly holds rates but might signal that cuts are getting pushed further out, and a set of earnings reports that will either confirm or challenge the biggest growth story in the stock market. In a best-case scenario, earnings beat, the Fed sounds neutral, and the S&P 500 pushes through 7,200 into new territory. Rate cut expectations stabilize at late 2026. The AI bull case stays intact. For a retail investor holding a diversified index fund, the important thing to understand is this: the S&P 500 is at an all-time high right now, and it got here despite technology as a sector being down roughly 7% year-to-date. Energy, materials, industrials, and consumer staples are what carried the index higher in 2026. That is a genuinely healthy kind of rally, broad participation, not just tech. This week's earnings will tell us whether tech can rejoin that rally or whether the index strength stays narrow. Let's look at the charts, because the technicals this week are telling a specific story, starting with the S&P 500. The index is at 7,165, a record high. The chart shows a sharp recovery from the late March sell-off, when the 50-day moving average briefly crossed below the 200-day moving average. That crossover pattern is called a death cross, and it typically signals caution. But the market didn't read that memo. It rallied hard on the Iran ceasefire and early earnings beats. The level to watch on the downside is 6,880. That's the first meaningful support. Below that, the 200-day moving average sits around 6,650. If the market needs to find its footing after this week, those are the two floors worth knowing. On the upside, 7,200 to 7,300 is the resistance zone, Fibonacci extensions from the recent rally. That's where the market would need to prove itself if earnings come in strong. Now the NASDAQ composite, also at a record high, at 24,836. The key zone to watch is 24,500, which aligns roughly with the 200-day moving average. That level represents the line between a healthy pullback and a more meaningful retracement. The NASDAQ's record high masks a split story. NVIDIA and Intel are carrying the index while Microsoft has significantly underperformed this year. This week's earnings will resolve that split one way or the other. Finally, sector performance. This is the picture most financial media isn't showing you. Energy is the best performing sector in 2026, up between 21% and 36%, depending on how you measure it. Materials and industrials are both up double digits. Consumer staples have quietly gained around 15%. Meanwhile, technology, the sector that dominated 2024 and 2025, is down roughly 7% year to date. That is a significant rotation. Growth to value, momentum to fundamentals. If this week's AI earnings deliver, that rotation may slow. If they disappoint, it may accelerate. The chart shows the S&P 500's rally is real. It just isn't a tech rally, not yet. Here's what you can do with this information, and what you probably shouldn't do. This week will be noisy. The signal is in the earnings results themselves, and in the Fed's language around the inflation timeline, not in the minute-by-minute market reaction. This week is one of those moments where the calendar just lines up, a Fed decision and the biggest earnings window of the year arriving at exactly the same time, with markets at all-time highs and inflation still above target. If you found this breakdown useful, drop a comment below. I'd genuinely love to know which part of this week you're watching most closely. And if you haven't subscribed yet, this is the kind of week where having the follow-up video in your feed matters. As always, everything in this video is for educational purposes only. This is not investment advice. Do your own research, consult a financial professional if you need one, and never make investment decisions based solely on what you see in a YouTube video, including this one. See you on the other side of Wednesday.